Perhaps we could start there because we did suddenly get this surprise, expansion in U.S. manufacturing. That economy is not slowing down. What does that mean for a cutting cycle and when it might start?
Good morning, Vinny. So what we are seeing is that there is a strong domestic push within the U.S. Domestic consumption stays very strong. Now that, of course, with the manufacturing data that came out yesterday with its definite expansion territory, and that seems to be a global phenomena. China also came out with strong manufacturing data. So whatever we feel about markets at this point, that especially in developed markets, we have seen this rally, 10% in the US, a bit more in Japan, a bit less in the Eurozone. Consumption seems to be still strong globally, and as long as that's there, we're going to see markets rally or at least hold these levels. Now, coming back to the US, it's, of course, the stimulus that came in through COVID times is going to be shrinking away. So that data is still not there. Hence, we expect markets to be resilient.
Yeah, so if markets are resilient, do you pick the same places that have been performing well over the last year or two? I mean, do you stay with tech and do you stay with, some of the other growth sectors as opposed to rotating into value, as some investors have been saying?
We stay with growth for the simple reason that share prices are completely dependent upon earnings growth, upon profits. If you're going to be getting that earnings growth out of tech and healthcare, of course, at reasonable valuations. You cannot be at a very exponential valuation and then expect the company or the stock to continue, going up. No, that's not going to happen. But as long as companies give good guidance, we are getting the Q1 numbers very soon in a week's time. And when that starts flowing through, that's going to be the next catalyst for the market. Yes, we stay with tech, but selective tech, very profitable companies, very conscious of what's going to work. And, as we say, and it's pretty commonly said that, in the short term, you tend to overestimate what technology can do. And in the long term, you underestimate. So we are in for the longer term winners. And we do like healthcare. We like anything to do with obesity. We like anything to do with the impact of AI in diagnostics. We also like energy right now.
Energy. Well, tell us a little bit more about that. What kinds of energy companies?
Of course, the exploration companies, so anything to do with the big explorers globally, whether it could be Saudi Aramco in Saudi Arabia, it could be Exxon, Chevron in the US, BP, Shell, just to give you, an example of what, are the big. We also, like, anything to do with gas at this point. So, again, we're thinking that, gas is a beneficiary of what's happening with AI, also a little bit of the green revolution. Energy companies, also lots of them have great dividend flows. And not too many of them are going big into capex. So they've got that cash flow coming back to investors. Oil prices, Brent is about $87 this morning futures. So I think that trade should play off into this year.
Moving into this region a little bit more and emerging markets more broadly, there was a theme in the markets yesterday, and it could be continuing today. It's, difficult after one day to know what's actually happening, but that perhaps the Japan trade might be coming to an end and that China might be a beneficiary of that. There's also the idea today that India might be at an end and that China might be a beneficiary. What say you?
Okay, so we are looking at fundamentals here. China's growth is forecast to be around 5% GDP. India is still at between 6.5 to 7. Japan is coming out of a deflationary phase. Now, ROE in Japan is still low by standards if you look at India, if you look at the US. But we think that with the yen being low, exporters are still benefiting in Japan. We are still overweight Japan. India, we stay overweight for a long-term secular perspective, not just, immediate short-term gains. On China, we've always said that we're going to see that spike. We're going to suddenly see equities start to perform. And now with the recent manufacturing data being positive, more economic data points coming up, you could see that rally. However, on a longer-term strategic viewpoint, we still favor India and Japan.
You could see that rally in China, but why should one data point suddenly convince investors when, activities from the central bank, from the PBOC, from monetary authorities, all sorts of efforts to, let the economy sort of do its own thing haven't worked for investors so far?
Absolutely bang on out there, because we are still neutral China. Okay. So what we are saying is stay invested in China, be market weight only, but we don't have to go overweight China right now. We're still waiting for further stronger catalysts that could be, longer term. And of course, what in China, some things work, some things don't. Electric vehicle industry seems to be working. The real estate sector is not working.